Hi, everyone. This is Jason Bjerk with Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. With the gold price way above $3,000 an ounce today on Thursday, March 20th, 2025, silver price also saw down a little bit below $34, but it's had a pretty substantial rally over the last couple months. But the gold price is really the superstar lately, the surprise macro star. Wanted to get back on a returning guest. He covers gold and gold stocks. He wrote a textbook, a full-length textbook. Let me pull up the name of the textbook real quick for our listeners out there who are interested. How to invest in gold and silver. I believe it's on like series 10th edition now. Well, 10th. I was going to say 7th or 8th. We're on edition number 10 for January 2025. Don Durrett of Gold Stock Data. Thank you for joining me again.
Yeah, thanks for having me back, Jason. Yeah, the reason why so many editions is I like to keep it updated because it's very easy for gold and silver to get out of date.
Well, also there's new products. I mean, so there's new companies out. You have what the Sprott physical ETFs. You have new royalty and streaming companies. Some of these mining companies, there's mergers and acquisitions. So some of the companies you might talk about might not exist after a couple of years.
Yeah. It's a very quick changing industry.
Well, there's some interesting innovations there. I mean, you've been covering this. I've known you for over a decade now, and I remember back in like 2008 and 9. I mean, there was plenty of money to be raised by a lot of these Vancouver merchant investment banks, right, for a lot of these juniors. And over the course of the creation of a lot of those mining stock ETFs and the popularity of Bitcoin and other cryptocurrencies, those Vancouver merchant banks, they stopped existing and they stopped raising funds for a lot of the junior miners. And so the royalty and streaming companies were the ones that were coming in and funding a lot of these juniors. So there wasn't as much capital available for a lot of these smaller companies.
Yeah, I'm seeing my database start to shrink a little bit. There's a lot of these smaller companies went bankrupt here because we've been in a correction since 2012, 2013. So basically 10-year bear market, 10 plus year bear market in gold and silver mining stocks, where sentiment has basically been down. We're on the verge here of sentiment improving. We can talk about that. But yeah, it's been a 10-year plus bear market. And so it's been really hard for the juniors to raise money. Difficult for developers to raise money to build a mine, and difficult for exploration companies to raise cash to drill. So yeah, it's been tough. We're starting to see a little bit of a turn. Today there was like four financings. Um, so companies are the better companies are having an easier time raising money right now.
Yeah, I agree. I would imagine the terms are going to get easier if the gold price stays at these levels or go higher. We've seen with the earnings, what the Q4 earnings, the Q1 earnings for 2025 are not out yet for the larger mining companies, but the Q4 earnings for 2024 were a substantial increase in the free cash flow for what Barrick Gold, Newmont Mining, even First Majestic Silver, the superstars like an Agnico Eagle, a Lundin Gold, and Alamos Gold. They had very robust numbers. There's a lot of free cash flow from at least the producers now to go and reinvest into those juniors. Whereas a couple of years ago, Don, some of the terms were bad. I'll just throw an example out there, like a company like Bonterra with a lot of good assets and a mill that can be expanded right next to the windfall mine in Quebec. I mean, they got really onerous terms just to survive a couple of years ago on a joint venture deal. I doubt they would have to give into those types of terms right now, but the deal's already done.
Yeah, it was very disappointing when they lost their project.
Well,
Yeah, it's been a tough road for a while.
so before we start talking about maybe some of the gold stocks where the free cash flow is going, some of the companies that are actually raising funds to start building a mine that you might like, I want to get your thoughts on the gold and silver markets right now. So I see a lot of the gold and silver community talking about problems with the LBMA and the COMEX. Do you think that that's one of the major reasons why the gold price has relative strength in the macro environment, or do you think there's other reasons?
I primarily think it's other reasons. So gold broke out a couple of years ago, actually. Gold's been in a bull market for quite some time. I mean, if you go back and look at the chart and you look at where it kind of broke out and it's been running, silver has had more of a struggle. But gold, I mean, especially the last 12 months, so gold was up 27%. It pretty much ripped. It went through 2000 like through butter and never went back and retested it. and it just kept going and going and going. We haven't had a significant correction in gold in quite a while. And so I don't think that was LBMA inventory related. Now it's what's happening is because that run just kept going and going and going, and now it went through 3,000 and it didn't retest 3,000. We're at spot 3,044 last I looked. It's almost like the same thing that happened at 2000. I mean, it's going through and didn't go back and retest it. Um,
Well, I think things changed dramatically, Don, in early 2022 with the Russia sanctions. Because here we are, we're recording this interview on Thursday, March 20th, 2025. That's 3 full years, a little over 3 full years after the Russia sanctions. That's 3 full years for these non-G7 central banks to say, we're not buying a lot of treasuries anymore. We're accumulating gold tonnage more each month. Now, they're not increasing the amount each month necessarily, but that's still 3 full years where the dollar cost average more than in the past.
Right. So we can look at these factors. You know, you mentioned the LBMA, and I'm just saying that that is starting to become a big factor. But if we go back and we look over the last few years, you go back to 2022, which I think is a good year because that's when the BRICS were became expanded because Russia needed made an alliance basically with China because they got pushed out of the U.S. They got pushed away from the U.S. So they basically created an alliance with China, and then they started creating an alliance with the Middle East, and the BRICS started expanding, and now the BRICS are moving away from the dollar, and so that had a big impact on gold, absolutely. So as you move away from the dollar, you move towards gold because there's no other currency out there to replace the dollar. So gold's kind of a proxy for the dollar. So that was kind of a start of it. The BRICS, absolutely. That was one factor. Let me name a couple more. I think that Basel III is huge. Basel III goes into effect in Europe next year, and they're talking about the US this year, but I don't think it's really going to impact go into US until 27. But these banks are all going to start front running Basel III implementation. Basel III makes gold a tier one asset. It currently isn't a tier one asset. And so once it's become a tier one asset, what that means is they can actually loan against it 100%. And that's huge. And they can use it as assets for their liquidity.
That
And
means
for
it's like prime collateral similar to US Treasuries. Is that what you're talking
Yeah,
about?
that's exactly what it becomes starting next year in Europe, and possibly next year in the US, but I think they're going to delay it till 27 in the US, but it doesn't matter. Once it happens in Europe, that's a huge impact for gold. So these banks, you have the central banks accumulating gold. Now you're going to have regular banks accumulating gold. That's huge. I think Basel III is a big impact. But I actually think the biggest factor that we haven't mentioned is the US bond market. And the US bond market is becoming fragile, I believe. I mean, if you look at the auctions, we've had a lot of big tails on auctions. Anything that's 5 years and longer, we've had these big tails. A tail, for people in the audience that don't know what that means, is that means people were offering interest to pay at a higher interest rate than what the auction opened at. And so they're like, so let's say the 10-year opens at 4.2, and people will bid a little 4.2, and then they bid higher, and then it ends up you have all these bids at 4.23, 24, 2. So that's what a tail is.
So the
Now we're
yields are spiking then. So there is some demand for these treasury auctions, but the investor wants to be compensated for inflation or the budget deficits. They still want a higher yield. Is that what you're saying?
Yeah, and the auctions push the rates higher. Um,
Well, for our listeners out there too, this also creates pressure on the older bonds because the value of the older bonds, if the investors are coming in saying we want a higher yield, we want to be compensated for inflation and these budget deficits that Doge is not cutting, they're going to say that the older bonds with the lower yields, we don't want those. The value of those older bonds, the principal value is going to have to go down to compensate the investor. So the older bonds are going to lose a lot of value.
exactly. And when you get up to $2 trillion in annual deficit, and this year we had 1.1 trillion the first 5 months of this year, which starts October 1st, either October 1st or November 1st. But our fiscal year, the U.S. government's fiscal year It's October is when we don't do January, it's October. So the first 5 months it was 1.1 trillion. So we're going to go over 2 trillion this year. That's $166 billion a month they have to borrow. And foreigners haven't really been showing up at these auctions. They've been slowly staying away. And the U.S. cannot fund its own debt that way. Who's going to show up? So my point is that the bond market is becoming fragile.
Well,
The rest of the
especially
world
with
is noticing this.
Well, especially to add to your points there, with the two main buyers of treasuries in the past for the last few decades were Japan and China. And the US has started a trade war with China. So China is not going to go buy a lot more US treasuries because look at these retaliatory tariffs and the national resource policy. I think the US government's going to start stockpiling copper now, and there's tariffs on Chinese steel and aluminum, I believe. So there's all these things here. So the other countries, especially with the Russia sanctions. I really think, Don, the last 3 years, the gold market just seems very different to me, especially with the central bank buying. There's been a much higher dollar cost averaging the last 3 years. It started 3 years ago. Now, it hasn't increased a lot lately, but that's a higher plateau the last 3 years for demand for central bank. Then 18 months ago, give or take, I think like the end of 2023, you had October 2023, I want to say, you had a huge demand in Asian retail investors. That was around when the Asian currency started to get weak. So they all wanted to hedge what inflation and their own domestic currency weakness. So we just saw from Asian retail and Asian pension fund money, the institutional investors there, just a huge increase in allocation to gold and silver. These pension funds and institutions, Don, correct me if I'm wrong, a lot of them didn't have any exposure to gold and silver up until the last year or two.
Right. People don't, a lot of investors do not realize what's happening today economically and the change. And gold is basically kind of the clue that something big is happening here. So you have $250 trillion in stocks and bonds that are at risk if the US economy goes into a severe recession, because the US economy is 25% of global GDP and it's highly levered. So if that goes south, the entire world is going to have trouble. So it's $250 trillion at risk. Um, and in gold, there's only about $6 trillion in bars and coins that basically available to purchase. Everything else is basically artwork. They talk about 33, $40 trillion in gold. It's all basically artwork, but the actual bars and coins is about 6 trillion. Of that 6 trillion, 60, 70% of it is owned by people that aren't selling. So the market, the liquid market for gold is only about $1 to $2 trillion versus 250 trillion. So if that 250 trillion decides they want gold, the price of gold is going up, up, up.
Well, and
So
central banks, according to the World Gold Council in 2024, I believe global central banks bought around 40% of the annual mine supply, so around 1,000 tons. So that's like a substantial amount. So the central banks are just accumulating. That's dollar cost averaging. So there's not as, to add to your points, there's not as much physical metal for the people who want to start allocating 1%, 2% of assets under management to gold. I was listening to interviews and checking articles. I think one of the largest pension funds in Thailand, they had zero gold exposure in the last year or two, and they just added 30 or $40 billion. They made an announcement. The article was on Kitco in the last 12 months. They were going to buy 30 or 40 billion worth of physical gold. And then I just saw another interview with Nolan Watson of Sandstorm Gold, and he just said one of the largest pension funds in Canada had sold all of their gold exposure off of the last 5 or 6 years. And now he said he was told by one of them that they're going to have to start adding back to 1 or 2% assets under management for gold, physical gold exposure and gold stocks over the next like 12 to 18 months.
right. And central banks, when they buy gold, they don't sell gold. They're accumulating it, put it on their balance sheet. So they're taking inventory off of the market. So I think my 1 trillion to 2 trillion is a pretty good number as far as the market. So once it's soaked up, once it's gone, we could easily see gold rip here to $4,000 in the next 12 to 18 months. And the key here is I've been saying the number one data point, the only data point that really matters for gold is the S&P 500. So those are basically the 500 largest companies in the US. So the US stock market is like 60% plus of the global stock market. So those 500 companies are like, they're like the big chunk of the global, economy. If the S&P 500, so it's down 8%, and I think a lot of European money is finally, so the European money came over to the US and has been made a whole bunch of money on the Mag 7, and now they're going home. And you can see the European stock markets are going up this year. The Mag 7 are all negative this year except for Meta.
So, Don, you were talking about the capital flows that had come into the US and were chasing Nvidia and the other Mag 7 stocks higher on the artificial intelligence side, but you said that those capital flows are now starting to leave the Mag 7?
Yeah. So I don't think investors realize how at risk the US economy is. And we've been propped up by a lot of foreign money. We've been propped up by US government deficit money. So a lot of this liquidity, I've called it a Potemkin economy. Things can turn south very quickly as the foreign money pulls out of the stock market. Trump adds these tariffs and we go down more on the stock market. Somebody was saying that the US government, their revenue, they get a huge amount of money from capital gains. And so if the stock market goes down, then the US revenue goes down and their deficit goes up. It's going to be, I think, a spiral effect, a negative spiral effect that's going to begin here in early August when these tariffs go into play. Trump is making
August or
epic
April? Didn't he say April or
April 2nd. Yeah, I say
okay,
August. Yeah, April
you said
2nd.
August. Okay.
Okay. Yeah,
Yeah,
thanks for straight.
I think this year, the next couple of years are going to be tough for reasons that you said, with the budget deficits, the lack of foreign demand for U.S. Treasuries, refinancing the Treasury debt, which Yellen put a lot of that short term. I think there was 9 trillion, something like that, over the next 18 months that needs to be refinanced at higher interest rates. So
Yeah.
these things are not very good. And then if tax receipts do collapse for what stock trading, the S&P 500, or home sales, home prices, there's not a lot of home sales for property taxes and home sales. I mean, like there could be a huge shortfall in tax receipts at the federal level. In my opinion, my whole thesis here, with one of the main reasons for the quantitative easing programs, when in 2008 and 9, and then what again in 2020, one of the main reasons the Fed went to zero interest rate policy in QE was to try to juice the asset prices back up because there was a 6 month or more shortfall in the tax receipts.
Yeah. So I think we can go back to 2008, the last recession, 2008, 9, and kind of extrapolate what's happened from then until now. So back then in 2009, the Fed was able to lower rates. They got them down to zero for the almost, on the short end. And then they were able to inject liquidity into the market whenever they needed to. If you look at the stock market and you look at M1, M2, I guess we don't have M1 anymore, M2, every time the stock market had a 5% reduction, the liquidity they just injected money back in. So it was basically a manipulated economy since 2009. So we've had 15 years of growth. I was listening to a Jim Rogers interview yesterday, and he said that this is the longest expansion without a recession in American history, is what he said. I don't know if he's right or not, but this has been an extended, manipulated economy. But what is interesting about this whole period is that it wasn't growing on its own. So this wasn't like the 1990s, especially the mid to late 1990s, when the U.S. economy was growing on its own. That's not what this has been. This has been a 15-year low interest rate, heavily liquidity injected growth. I mean, you go to 2020, they injected $4 trillion. The Fed's balance sheet got up to 8 trillion, and the federal government's deficits were massive. It's been a very manipulated economy, and now Trump, he came into office and he basically realized we can't keep doing this. This is not tenable. But the problem is that he's trying to fix a problem that's been building for 50 years. The globalism. He wants to reverse globalism. But reversing globalism, when we have inflation, when we have a slowing economy, is going to be really difficult. Not only is it going to be difficult, but he's playing with fire here because if he creates a recession, and I think he will, there's a possibility that this high debt situation we have in the U.S. could literally spiral out of control. Where we have, and I think this is going to happen, where you just have banks closing, regional banks closing left and right, and there's nothing the Fed can do to turn it around because they can't print money to such an extent to restart the economy. Because if they do that, they're just going to destroy the currency and create inflation. So they're going to have to do it slowly. The same way that they killed inflation, that's how they're going to have to restart the economy slowly. But I think it's going to take at least 3 years to restart the economy.
Well, I would argue that there are no good options. So we've basically hit the point where a lot of the macro experts like Lynn Alden and Luke Groman and others have talked about with financial repression and yield curve control. We finally got to that point where the Federal Reserve Bank, the Treasury Department in DC, after many, many years of $1 trillion budget deficits or larger per year, where we've gotten to basically the point where there are no good options left for the Federal Reserve Bank. I would also argue, Don, that over the last, especially 18 to 24 months, the jobs reports have been even more fake than usual than in the past. So like they've been counting like the U.S. federal government. I'll give examples. U.S. federal government or the state level hiring new government employees, right, for whatever stupid government program was wasted on DEI or Medicare, Medicaid, other ridiculous stuff, handing out debit cards at the border to illegal immigrants as they passed, and that was counted as a beneficial full-time job to the economy. And then a month or two later, it was revised downwards. So like I think 30%, Don. I don't know if you saw the jobs numbers. I think they said about 30%. No, it was 80%, I think, of all the jobs created in the last like 2 years were government employees or something like that. Some insanely large number were government jobs.
Yeah, and they haven't been able to hide the participation rate, which has never come back, and the full-time jobs have shrunk. So a lot of the jobs, the job growth, they consider a part-time job a new job, which is kind of a joke. So yeah, you're right. The jobs numbers have been weak, and they're not right now. You don't want to lose your job right now. It'd be difficult to replace it. I think if you look at the economy right now in the whole, Trump has been handed a really tough hand. I think retail. I mean, FedEx just came out today. They had to revise lower. They're basically revising no growth this year. Retail is basically flat. There's no growth in retail. Housing, autos, a lot of downward pressure because of high rates. Banks have delinquencies. We're having a lot of bankruptcies. So Trump, the best thing that Trump could have done is basically said, screw it, I'm just going to kick the can down the road. I'm just going to keep, I'm going to do my tax cuts. I'm going to keep high deficits. I'm going to keep the fiscal spending going, just kick the can. I mean,
Well, he
the,
wanted to do the tax cuts, Don. I think like Congress is like stalling stuff. I think that's the issue there is like they put the tariffs in first before the tax cuts, because the tax cuts are being blocked right now by both houses of Congress. They can't
well,
they can't agree.
right. But I think all he's trying to, yeah, they're definitely going to be haggling over the tax cuts. But my point is that what I meant by kick the can was not do these tariffs. In other words, keep the Biden economic policies in play, and just spend and pretend, right, and just kick the can down the road. That's what Wall Street wanted him to do. Just spend and pretend, and just wait until we actually don't create a recession. Don't create a recession. Let the recession happen and then fix it. But Trump's like, no, I'm not going to wait because Trump has pretty much decided that he's going to try to fix this thing. And the hardest thing to do is try to hold something up that it's like putting a ball underneath the water. It's just almost impossible to keep it under the water, and that's kind of what Trump is trying to do here. He's trying to keep the economy growing when it's slowing, and then simultaneously to add tariffs on top of it. So yeah, I think it's going to totally blow up here, and gold is going to be the big beneficiary. Now, a lot of people they always like my target, so I'm going to give them here. So we have 357 on the Hui, which is, outstanding, but I don't consider that the breakout level, unless silver confirms it. So we have gold at 3,044. My breakout was 3,000, and for the miners, I'm talking about the gold silver miners. And then the Hui was at 350, so we're above it, but I think it's a fake breakout. And then the third one, we need all three to have a breakout, is silver above 35, and silver is 33.46. Let's call it 33.50. Silver's like lagging back. And I don't think that silver is going to be able to get above that line before April 2nd. And then April 2nd is going to come along. And then silver is going to get pushed all the way down, I think, below 30. So a 10% correction would take it back to 30. And I think what's going to happen here in April is we're going to basically going to get a pause slash correction in everything, gold, silver, the miners, and the S&P. And I think that that pause could take gold all the way back down to somewhere between 27 and 2,800, and silver between 27 and 28, and the HUI between 270 and 280. So that's what I see coming. And then May, we'll get through April, and then we'll see where we're at May 1st. But I'm very bearish April for everything.
So it sounds like there's going to be potentially a buying opportunity for some of the gold and gold stocks that have already had a run up. I mean, like Franco-Nevada for the royalty companies, the shares were, I remember nine months ago, they were still around $120 a share. Now I think it hit above $150 a share, and Wheaton Precious Metals just hit an all-time high. So you're saying that there will be buying opportunities for some of the best companies then if your correction plays out.
Yeah, absolutely. I think you'll get a 10% correction, just about every stock, every miner. That's my expectation. Now, maybe we'll get lucky and it's only, a 5% correction or no correction, but that's unusual. You usually get a 10% correction every year in the miners, even during bull markets. So it's common to have a 10% correction. It's not unusual at all in the miners. They tend to be very volatile. Let's just cross our fingers that they only go down 10%. But the HUI 357, 10% would still be above 300. I don't think that's going to happen. I don't think 300 will hold. So I'm thinking we could see 10 to 20% in some of these miners. But I, I'm my gut says it's only going to be 10. So
Well,
it's
I
just
just checked the GDX. It's still only at 45. I mean, it's still way off the all-time high in 2011 of what, $64, almost $65 a share. That's the gold miners ETF. So even though the gold price is way above 3,000, I mean, the market just doesn't believe it. It's severely discounting this move. Now, we've seen some individual gold miners or gold royalty companies, whether that's an Agnico Eagle, an Alamos Gold, Lundin Gold, which has arguably the top mine in the world, and then a Franco-Nevada and Wheaton Precious Metals. Those shares are bucking the trend out of the industry, but the majority of the industry, I mean, is still way lower than I would argue those levels for 45 GDX. That's sub $2,000 an ounce gold for a valuation.
Yeah, last time I looked, they were averaging 6 to 7 on a free cash flow multiple. They should be double that. They should be 12 to 14. Well, that was all the producers, so maybe 10 to 12. But it goes 50% off. I think the average miner, except for the ones you mentioned, Agnico Eagle, Alamos, Franco Nevada, those are elite. So they're not off 50%, but your average miner is about 50% below where it should be based on the $3,000 gold price. I think that these gold miners, at a certain time when we finally break out, I think that the gold miners are all going to double very quickly, just because from multiple expansion alone. So if gold goes to say 3,100, 3,200, probably going to take 3,200. And silver, the key's going to be silver. Silver gets above 35. I think these miners will double very quickly. It'll make heads turn. Um, that's my expectation because they're so undervalued. And when people finally go to them, you get a little Momo going. And once that Momo starts, then all the money comes flooding in. And so we haven't had that yet. We have not had that Momo. You mentioned GDX at 45. It's a good example. Newmont, 45. I mean, Newmont was at 82, 84 in 2022. So, yeah, these stocks are they're like rubber bands. They're ready to rip. But I think that one of the reasons why they're cheap right now is because nobody wants to catch a falling knife because everybody kind of anticipates this 15-year bull market coming to an end. It's like, everybody's, the Fed keeps saying, soft landing, and I don't think the average investor believes it. We're going to get a recession. And when we get that recession, you're going to get that pullback. That's why, yeah, I think they're going to come back 10 to 20% here. And I think that's the reason why they're cheap. Now, normally they would come back 30%, but during a crash, but the stock market goes down 20%, the miners are going to go down 30, 40%. But the reason why they're not is because they're so undervalued. So you're not going to be able to push Newmont. So Newmont was at $30 a year ago. You're not going to be able to push it back to 30. I don't think you'll be able to push it back to 35. So the bottom, I think the bottom is definitely in on the miners. So we're going to get a higher low, but I do think we will get a correction. I do think Newmont probably will go down sub 40.
Now, these gold miners, a lot of them with the earnings recently, especially like a Barrick Gold and Newmont, which had problems with costs over the last couple of years, their costs kept going up, seemed like 20, 30, $40 almost every couple months throughout the course of our interviews and checking this back and forth with their earnings. So they always had cost pressure. But recently, their earnings for Q4 2024 that came out in the last month or so, they actually didn't have cost pressure because I think energy prices were relatively stable or headed lower. So they had higher metals prices and lower energies prices, which resulted in record or at least an increase for the foreseeable future next couple quarters in free cash flow.
Yeah, absolutely. The earnings for Q4 for just about everybody was their cost had not, very few companies had cost problems or costs were blowing out. Most companies, their costs were either flat to maybe up $50. And a lot of companies were actually projecting that costs were going to drop over the next couple of years, which is very, very positive. Like a New Gold, I mean, it's pretty amazing. New Gold, they're projecting their costs to just keep dropping over the next 3 years. So we're seeing some companies where their costs are either contained or dropping. On the whole, the margins right now, the average margin, ASIC right now is about 1,600. So we pad that by 400, you get to 2,000, and you're at $3,000 gold. The average gold miner has $1,000 margin right now. That's the average. So there's quite a few companies that have $1,500 margins right now. That's pretty huge, and they're not really getting the multiple they deserve for that kind of a margin. I think Agnico, their multiple is like a 12. It should be at least 18. With the cash flow. But investors are like they're not trusting this $3,000 gold when in fact gold's actually going to go higher this year. And so investors, it's pretty amazing. We're going to see a flip, a pivot at some point where investors finally recognize that gold's going higher and that the miners are undervalued. I don't know when it's going to kick in. I don't think it's going to be April, but maybe it'll be May or June.
Well, I don't know exact timing on that when there's going to be a re-rating revaluation on the multiple. So if you and me were running these gold miners, Don, where we had good free cash flow, I mean, what do you think they're going to use for their free cash flow? Are they going to announce a variable rate dividend depending upon the gold price, or just announce a regular dividend hike, a more stable increase in the dividend, say like an 8% dividend increase? Are they going to announce share buybacks if they think on a discounted net present value future discounted cash flows smarter to buy back their stock if the cash flow multiple you said is lower, or do you think that they're going to do a merger, some type of mergers and acquisitions? Because Agnico kind of has done some under the radar moves. I don't know if because you cover a lot of juniors, you have the largest database of juniors. Agnico Eagle has quietly done some smaller acquisitions. They bought a lot of the land, either 100% purchase with one of the juniors, I think 03 or something around Canadian Malartic. And they just locked up another $70 million deal with another one of the juniors with the land package too.
Yeah. Yeah, they O3 Mining they acquired, which was absolutely outstanding. And now they've taken a 15% interest in Collective Mining. Yeah, I really like, yeah, Agnico Eagle, man, Sean Boyd, man, that guy's he's good. They're making some really good acquisitions. Yeah, back to the margins here on these, what they're going to do with this money because they're generating a lot of cash. Endeavor Mining announced today that they were going to buy back 10% of their shares. That's what's starting to become. I'm starting to see that. Dundee announced they were going to buy back 10% of their shares. Now they have to go to these agencies, regulatory bodies. If they're going to do buybacks, they have to put paperwork in to do that. And both of these companies have done that. So we're going to see more companies. Now they don't have to buy back. It's an option for them. They don't have to buy back 10%. They can buy back 30, 3%,
It's
5%.
up to 10. Yeah. So they have to
Up to
file it. So
10.
for our listeners out there, if they're a Canadian company, it's a NCIB normal course issuer bid, and it has to be renewed each year. So they can say with the filing, like Don says, they can buy up to 10% of their stock back.
Yeah, so we're gonna be seeing a lot of companies do buybacks as they get a lot of cash in their balance sheet, and then in combination with the buybacks, they're going to increase their dividends, and that combination is going to be a thing of beauty for any company that has a pristine balance sheet. So if you have 300 million or more cash on your balance sheet, and you're generating $1 billion in free cash flow, oh my goodness, that is such a thing of beauty because at that point, that entire $1 billion they can give back. In other words, they just keep the 300 million on their balance sheet, and that entire $1 billion they give back to their shareholders. That is just a thing of beauty. And I think that is what we're going to see over the next 24 months. We're going to start to see these companies clean up their balance sheets and do buybacks and do dividends. The other thing they're going to do is they're going to increase the reserves based on gold price in the ground so that they can do these cutoffs. So I think they're going to raise their price to $2,400 an ounce in the ground. So they're going to raise it. Well, most of these companies have their reserves based at $1,800 gold. Some of them lower than $1,800 gold. And so, some of them do it on an annual basis. Some of them don't. They just, and so they basically the reserves and their M&I is all based on cutoffs. And so if they raise the price of gold to $2,400, they can raise their cutoffs and have a lot more gold in the ground. A good example is like Free Gold Ventures. They could their cutoff because they have a lot of low grade gold. They lower their cutoff. They literally go from 30 million to 40 million ounces. So we're going to see some of that.
Are they building a mine now, or are they like at pre-feasibility? What stage are they at?
No, they're just a pure explorer in Alaska. They're right next to the Fort Knox mine that Kinross owns, and all they're doing is drilling it. They're not going to advance it. They're just going to drill that and keep adding ounces, and then wait for Kinross because it's so easy for Kinross. They have a mill. Kinross, the Fort Knox mine is literally, I think, 5 miles away. So that mill's they can use that mill for the Free Gold Ventures. So it's a perfect fit. So that mill is definitely going to mine all that gold. The Fort Knox mine has been in operation since like 2002, 2004, and it comes to an end in 2030. So in 2030, someone's going to, and that's where that ore is going. It's a huge mine. It's perfect for Free Gold, and it's 5 miles away. So they're just waiting. They're currently the gold in the ground is valued at $10 an ounce at 30 million ounces. But if they lower the cutoff, it's 40 million. So you're paying $8 an ounce in the ground. I have a friend who thinks they have 75 million ounces. I'm like, no way. But that's what he thinks. He thinks that they have 75 million. But that's just one example of these companies that when the price of gold goes up, a lot of these companies when they can lower their cutoff, and when they lower their cutoff, they can mine more gold.
Well, I
Now,
mean, the juniors may stay cheaper, they may get bought for a discount. So it just depends like what the mid-tier gold miner like a Kinross or a senior is willing to pay. Because these companies, we've highlighted over the last couple of minutes, I mean, I think they have record free cash flow now, as long as the energy prices don't start to creep back up or the metals prices don't crash, even if they drop 10%, still going to be a very healthy profit margin and free cash flow for a lot of these producers now. So they're going to, if their stock price and the other assets are going to stay very undervalued relative to metals prices, I mean, that extra free cash flow, they're not going to get any benefits to just holding cash on the balance sheet. They're going to start to put it to work soon in the near future. We've started to see what mergers of equals now, I think, is the term that Ross Beatty used for Equinox Gold with
Yeah.
the merger that they just did. Do you think we're going to see the producing miners first reinvest into their existing mines, what with upgrading mills, finding more exploration drilling, and trying to replace reserves or increase reserves around existing mines? Or do you think we'll see aggressive acquisitions with like one of the juniors that you just mentioned?
Yeah, I'm expecting aggressive acquisitions once gold and once silver breaks out and you get the HUI. One of the keys for M&A is when the board is not worried about blowback. So if you do a deal, I like right now, Caliber did basically a merger of equals with Equinox, and their shareholders aren't happy. And if I was a Caliber investor, I wouldn't be happy either. That vote might not go through. They need 66%, I think. Their largest shareholder said they're going to vote no. And so you get blowback, but so the board is always cognizant of the blowback. So if your share price is going to go down, but when your share price is trending like 10% a month, right? If the gold price is going up to 33, 34, 35, 3600, and the HUI is going up to 400, 450, 500, and your share price is ripping higher, when you have that scenario, you don't get any blowback. Everybody thinks everything's accretive because everybody's flying. So that's when you get a lot of M&A. So we need a bull market in the HUI. I mentioned that earlier. I think we need silver to get above 35. The technical chart on silver, I'm sure you've looked at it. We've only been above 36 twice, 1980 and 2011. So we've only been above that price twice. And in both times were for short periods of time, less than a year in both instances. So if you get above 36, there's no overhead resistance. And so that when silver gets above 36, you're going to go above 40 fairly quickly. I think you're going to go all the way to 45. At $45 silver, these companies become very valuable. Let's put it that way. And most of your gold miners also have a silver mine or also have silver offsets. Like Newmont is a good example. They have a huge silver mine in Mexico. They use all of that silver for offsets. It'll have $1 billion in free cash flow with just that one silver mine that Newmont has in Mexico. Silver goes to $50. They got $1 billion in free cash flow. They use all of that for offsets to lower their gold production. So it's very beneficial for gold miners when silver prices go up. And so I think silver is going to be a clue for when this whole thing all rips higher. And that's when the M&A is going to go absolutely bonkers. You're going to see consolidation all over the place.
Well, we've already seen some of that in the silver space. What First Majestic Silver did a deal, Los Gatos Silver, a deposit, and then what Coeur d'Alene just bought. They bought Silvercrest, right, for La Chispas.
Yeah. Yeah, we're down to 15 silver miners with a market cap over 100 million. 15. Pretty soon it'll be 12. It's kind of insane. And there's nobody out there to catch up, it takes a long time to build a mine. It takes a long time to expand production.
Well,
So
well,
so the
also
number of
most of
silver
the
miners,
primary. Sorry to interrupt you, Don, but also to add to your points there, most of the primary silver miners, or at least the ones that used to be primary silver miners 10, 15 years ago, I would say at least 50, 60% of their revenues now are either gold or copper added or some type of base metals
yeah.
like lead and zinc. So they're not, if they're not really primary silver miners anymore, at least in terms of revenues.
No, SSR Mining, they don't have any silver. Fortuna doesn't have any silver. I mean, yeah, these companies have completely went away from silver because silver, you couldn't make any money for the last 10 years. So they went away from it. There aren't any. Now there are some silver development plays out. There's a lot of big ones, but it's going to take time. Discovery, they got to build their mine, and then you have Vizsla, and you have Go Gold. So there's some big ones coming down the pike, but it's going to take time. And so it's not going to happen overnight. I think a lot of those will be consolidated too. They might not, like Vizsla, they'll probably get taken out before they get to first pour because it's such a good project. And Go Gold will possibly too, but Discovery won't. Discovery just acquired a gold mine in Canada. They have really strong insiders. Tony McCooch, they're going to become a monster company, a monster company. I don't. They're going to acquire another big one. I wouldn't be surprised if they acquired Vizsla or Go Gold.
Are we
Um,
at a gold price right now, Don, and cost of capital with interest rates, where a small miner that has like a good gold deposit that's like feasibility study, the numbers look good, they can go to a bank and say we can raise a couple $100 million to build a mine on our own? Or do you think that they can't do that even with the current gold prices?
it depends on their market cap. A company that has, it's a combination of their market cap and the capex they need. So their market cap gives them equity. So the bank, so let's say you have a market cap of 100 million and you need 150 million for the capex. So what the bank will do, so they have all that equity, that 100 million, and the bank will basically, okay, go and raise 50 million in financing through shares, and then we'll give you a loan for 100 million. And so that kind of works. But let's say that they have only a 50 million market cap and they need to borrow 150 million. In that scenario, the bank will probably tell them to pound sand. Sorry, you don't have enough equity. So it comes down to that same thing. A small business, you got to have equity to get a loan. So mine, their equity is their market cap. And
Is
so
that why the shareholders were upset at this deal with Equinox because they thought that junior, because I think they had what, a producing gold mine in Nicaragua or something like that, Calibre Mining, and then they were trying to build this very large gold mine somewhere in Canada, and so the board of directors were worried about capital financing, trying to risk the whole company to build this new gold mine, and Equinox has easier cost of capital now that Greenstone is cash flow positive.
Um, no, that the reason why Caliber investors are upset is because indeed Caliber they already financed it was Marathon Gold's their Valentine Lake project. That project is already under construction and it's financed, so that's not an issue. Caliber
Well,
will build.
it's on paper is not an issue, but as we both know, Don, these projects never come in on time and on budget. Look what happened with Argonaut
Right.
Gold and Mangino,
No,
and that
th-
project just fell right into the lap of
right.
excuse me, of Alamos Gold. Alamos Gold is sitting pretty now, and the shareholders of Argonaut Gold got the bag.
No, well, no, right. I haven't talked to any insiders in this, but I got a really good feel for how this all unfolded. This had nothing to do with Caliber approaching Equinox. Caliber was in great shape. They have like three excellent projects, Nicaragua, Nevada, Canada, lots of drill stories. Caliber was doing great, and they were going to get re-rated higher once Valentine Lake came into production. And that's why investors are upset. They're like, wait a minute, you're selling before the re-rating. What the heck are you doing here? So this had nothing to do with Caliber. This was all about Equinox approaching Caliber. And they needed Caliber because Caliber allowed them to acquire cash, help their balance sheet, and lower their cost. So Equinox had a problem, a bad balance sheet, and a cost problem. So this fixed all of Equinox's problems. Now, you would think, well, then why did the board of Caliber want to do this deal? And the reason why is because Equinox is very cheap, unbelievably cheap. I mean, they're because they have this high debt, high cost. However, by merging by Caliber merging with Equinox, Equinox becomes a good company overnight. And Caliber, because Equinox is undervalued, Caliber gets like a third of Equinox. And their upside doesn't go down. So Caliber was basically a nine bagger, I think, or maybe a 7, 8 bagger, and Equinox about nine bagger. And then when you combine them both, it's about an eight bagger. So a long term, in the near term, Caliber was going to go up more, but in the long term, it's actually a better thing for Caliber shareholders in the long term because Equinox is a stronger company than Caliber.
Well, Equinox has the Greenstone mine. That's near term. That's one of the top mines in the world for costs and production growth. So we'll see if it hits the nameplate production capacity. That mine's supposedly cash flow positive as of what, October, November 2024. I don't think it's at full nameplate production capacity. It's getting there over the next couple months. It'll be there. So that's one of the elite mines. Now, what they did have to do a bunch of added a bunch of debt to their balance sheet though. So in the short term, I mean, they had to what refinance, and because the mine didn't come in exactly on time and on budget, it was delayed what
Right.
6 months.
Right. So when you combine those two companies together, you create a unbelievably strong company. So this is why when Caliber's when they were approached and Caliber's board, when they looked at the combination, they're like, wow, this is a this is an unbelievably strong company because
They're
if
a
you
million ounce producer, right? They're going to be the combined companies, I think, around a million
yes,
ounces a year.
yes, and if you look at all their projects, so they're going to have, they have the Greenstone. Now they're going to have Valentine Lake. Plus, they're going to have the Los Filos mine in Mexico, which is a very high quality mine. They've had trouble down there, but I think it's all going to be resolved. And then the properties in Nicaragua. There's four very high quality properties. And then on top of that is the board. You got Ross Beatty running the show. It's Equinox is super well, they were super cheap because they have high debt and high cost. And so, like I said, when you combine them together, it's a very strong company. I hope that when Caliber it passes. I hope they get 65%, whatever they need.
Well, I
Because
see it on paper. I agree. On paper, it does look good a couple years from now, especially if they hit the
yeah,
production guidance numbers with Greenstone and the other Canadian mine that Caliber is throwing into there, that Equinox, the free cash flow. I mean, you're way more optimistic on Los Filos. I mean, they have to renegotiate terms with the local Mexican government. They have to get the royalty tax down, they said, before they make the investment to get the cost down at that mine. Otherwise, I think that mine was producing over $2,000 an ounce cost. It's a disaster.
um, I yeah, I'm very bullish. I think Los Feliz will get fixed. I think
Maybe. My fingers are crossed on that one. I mean, like I've listened to podcasts with the CEO of Equinox Gold talk about what has to get done to get it fixed, and like as of right now, that mine is way too high cost, and so I hope you're right.
well, gold price is going to go higher, so I don't think cost is going to be a problem. It's the politics, but it employs so many people.
But they
There,
said they need to invest another couple $100 million to get the cost down. See, so and they said they won't make the investments down unless they renegotiate the terms for the
yes,
local royalty tax. So they basically said the royalty tax, the local government, the tax has to come down before they make the hundreds of millions of dollars in additional investment to get the cost down. Otherwise, it's a money pit. It's over $2,000 an ounce cost. It's a terrible mine right now.
yeah, that is high.
But if it's the combined company though, Don, like on paper, I mean, like I don't think Los Filos is an issue. But if Equinox Gold is by itself, then it's kind of an issue. So if they have that other Canadian mine, then it will offset it because they'll have more diversification.
Right, absolutely. It's just got one of those does it add free cash flow or does it not? But it's a big mine, so one benefit. But the other thing I like about the combination is it finally fixes Equinox. Equinox has been a total mess for 5 years. So this could fix Equinox, and then Equinox now can be off and running. They can do additional acquisitions. I think Ross Beatty is one of the most aggressive CEOs out there. That guy's a shark. I mean, I think they're just going to keep doing acquisitions. I've been looking, who is the company that's going to be the shark that gobbles everybody up? Because we really haven't seen anybody out there that's really been the aggressive company. I am Gold tried to do it, and then they had to cool their jets. They started running into trouble, but we haven't seen that many companies that have just been buying everybody up. Um,
Well, I think that's a good thing because the industry during the bear market, what from 2011 to 2017, they wrote off tens of billions of dollars in bad deals. There was over $60 billion in bad acquisitions written off, and a lot of gold mining CEOs were fired. So I think it's smarter that they're being more efficient, they're being more strategic. Like I like the move that Alamos Gold did. They got Mangino right next door to one of their producing mines at a reasonable price when Argonaut Gold got into trouble. So there is some. I think I like the moves that Agnico Eagle made that were under the radar. So I think there are some shrewd deals. The industry is not, being super aggressive doing what dumb growth deals for and overpaying. So I think that's a key here. If you start to see that, I think that's a red flag.
Right. You know, yeah, the key is, getting a good deal, right? But man, I mean, these miners are so undervalued right now that I think this is the opportune time to do acquisitions before everything gets doubled and tripled in value. If you're gonna do the deals, you want to do them at a cheap price before they get expensive. So I actually think the next 12 months that's going to be the last opportunity. So I'm looking to see, who's going to be the shark out there. But you can always do mergers of equals. I love those. I like
Well,
to see.
let me tell you one of the companies I'm surprised. I'm surprised at Lundin Gold because they have arguably one of the top mines in Fruta del Norte in Ecuador. I'm very surprised they haven't gone and bought another mine in, say, Canada or somewhere a little bit safer for some more diversification.
They're absolutely overdue. Yeah, you're absolutely right. They're in a good position to do it. There's several companies that are similar to them, single property where they need to diversify, and they can do it. I think we're seeing companies like G Mining. They built their first mine and they immediately went and bought another one. It was smart. And now Skeena, once they get their mine built, they're probably going to have to do something. And then Artemis Gold they just got Blackwater up. I think they're going to be out there looking to buy something. So these single mine, a company that once they build their first mine, they want to find a second mine to defend themselves, because if you're just sitting out there with a single mine, you're kind of a sitting duck. So it's a lot easier to defend yourself when you have multiple mines.
Well, yeah, even one open pit mine in Canada, what there was the heap leach pad. I forgot the name of the one up in Canada where there was a heap leach pad leak because the mine they
Victoria.
didn't Victoria Gold. Yeah, there we go. Thank you. So
Yeah, it's a
Victoria Gold.
good example. That one mine killed them.
Yep, and if you talk to the engineers, I mean, they didn't want to get a joint venture partner, a larger miner there to help, so they did the most efficient means possible to cut some of the corners what they wanted, and there was issues with the leach pad, and then this is the issue with the one miner, like you said. Yes, it was in Canada. Yes, it was supposed to be safe, and there were still issues with the one mine, and look what happened to the shareholders there. So.
Yeah, SSR Mining, I mean, they had a huge problem in Turkey and they didn't go bankrupt because they had other mines producing. So yeah, single mine properties are risky. It's better to have two. So if you have two mines and one goes down, you got the other one running.
And this is why I want to see Lundin Gold. Fruta del Norte is arguably the top mine other than the ones that Agnico Eagle owns. But I'm kind of surprised they haven't been more aggressive going and buying something else. Maybe they'll go buy one of the ones in Canada that you just mentioned.
Yeah, there's a few nice development stories out there that are they could definitely acquire and build. Yeah, we haven't seen it. You mentioned it that CEOs are very it hasn't worked out well, so nobody wants to be
Well,
aggressive.
I think companies are talking deals. I think deals are being talked about. I think like the companies that are potentially being acquired, they don't think they're getting a high enough valuation, and they don't want to sell the company before the gold price moves. So they see that their shareholders are going to be angry. That look, if we sell the company now at a cheap valuation, the shareholders are going to complain saying we didn't get a valuation re-rating, we didn't get free cash flow or dividends or any of those things. So they're apprehensive to do that. They'd rather sell the company or do a merger or something at a higher multiple.
Right. They're also using $2,400 these development projects they're trying to acquire. They're using like 2,000, 2,200, $2,400 gold for their MPV. So they're not giving these companies the value that if you go up and do 2,800 MPV, then they look a lot juicier. But companies won't do that yet, but I think they will soon. So that's another big thing on M&A is the value of the companies really start to jump as the price of gold goes higher. They jump immensely. I mean, every $200 in gold, the MPVs can jump $200 million, depending on the size of the project, of course. But MPVs can really rip higher with higher gold prices. I know. I mean, if we look like at Paramount Gold Nevada, they have the sleeper project in Nevada, and they're not working on it. It's just been sitting there for years and years and years. and it has a PEA at like $1,200 gold. And just think when they go back and they do a PEA at $3,000 gold, how valuable that project is. And they're getting zero value for it, absolutely nothing. If you look at Paramount Gold Nevada, I mean, but that sleeper mine, at $3,000 gold works. I mean, it's a low grade gold mine, but it's big, over 2 million ounces. So it's going to be really interesting. There's a lot of mines like Lahontan Gold. I bought it at 2 cents. It was valued at $3 an ounce in the ground. 2 million ounce project valued at $6 million. Just insane valuations. But if you do a PEA on that thing at $2,800 gold, man, it's like you got an MPV like $700 million, and it's got a $6 million market cap. We're seeing some insane valuations. So some company can go to Lahontan right now and say, "Look, we'll we want to build this thing. Here, we'll give you. You're valued at 7 million. We'll give you 20 million for it, and we'll give you a bunch of shares." So I don't know. There's deals to be made. I mean, I really don't want to see that to happen because I'm a shareholder of Lahontan. I don't want somebody to buy it, but we're seeing some really Getchel's another one in Nevada that's silly cheap. Over 2 million ounces at $25 million. I mean, we're seeing a lot of these development projects, exploration companies that are just crazy cheap. I mentioned Free Gold Ventures at $8-10, Banyan $8-10 in the ground. It's silly valuations. This isn't going to last much longer.
Especially if the metals prices stay at these levels, because you're going to have the senior miners and the mid-tier miners. They're going to do the things that Don and I discussed earlier in the interview. So they're going to reinvest in the brownfields exploration, mill expansion at the existing mines. They're going to potentially look at dividend increases, either a stable base dividend increase or a variable dividend increase, depending upon the metals price. They'll do share buybacks, and then they will also do acquisitions. I mean, if we have free cash flow at the current levels, Don, if energy prices don't rise, metals prices don't crash, there's going to be a lot of free cash flow from the senior gold miners and the mid-tier ones to go and buy a lot of these projects over the next year or two.
The majors are all going to have multi-billion dollar free cash flows, multi-billion. So, what the heck are they going to do with all that money? Yeah, they're
A lot of
some.
good options. That's the thing about free cash flow. So the listeners here who've been in a bear market and listening for many years, you have not been in a bull market like this where you have just. I would argue that these are the highest profit margins. I think I've been covering gold stocks since 2008. I think these are the highest profit margins I've ever seen
It's
for
they're
some
the
of the
highest.
local. Hmm?
They're the highest ever.
Yeah, so like if you're a Franco Nevada or a Wheaton Precious Metals and you don't have to worry about your energy costs blowing out. I know Franco had the one specific asset problem with Cobre Panama, but still they have very good profit margins and free cash flow. You have a ton of options here. I mean, it's if your share price isn't taken off, going to start looking at acquisitions or doing share buybacks and stuff like that. If your share price is high, then you can use a higher stock price to go and do some acquisitions, go buy some other assets.
Yeah, so at the current run rate for free cash flow, Newmont's at 6 billion, Agnico Eagle and Barrick are both at 4 billion. And then that's the current run rates on these companies. So
Well, they're building, aren't they building? They have to spend a lot of money building the Cortez complex, right? The Robertson
that's
mine. So that's a
that
joint venture. They have to save the money to go build that. They just got their permits for that. So that Nevada, that's going to get built, but then they have free cash flow for other stuff too.
right. This is extra cash. That this is on top of their CapEx spending for this year. But yes, um, Newmont can't pay back all their debt this year, but I think Barrick can, in theory. But these companies can pay down their debt in over the next 2 years if gold prices go up and their costs don't go up. Just about every company can pay off their debt in the next 24 months at these gold miners at these margins. If the margins stay where they're at right now and gold prices don't go down, we're going to see some really good balance sheets.
I think
Uh,
the other surprise here, Don, is based on kind of the Trump policies, the data centers, kind of like a mix of macro factors, and then also with the Trump policies with the tariffs. You have a copper price, didn't it just hit $5 a pound in the last week or so? So now with a lot of these gold miners, they have a lot of copper byproduct at a lot of these copper and gold mines. So you have a lot of copper byproduct that's throwing off a lot of extra revenues and free cash flow that you weren't expecting to. So you could potentially
wow.
reinvest that as well.
Wow. Copper's at 511 right now. It's over $5. Yeah, Newmont and Barrick, they use copper as offsets. At $5 a pound copper, Barrick and Newmont and all these majors, their are going to go down this year with those kind of offsets. Well, you give them $5 a pound because um, they're making at least $1 profit per pound of copper, and they mine a lot of copper. But yeah, that's stunning. I knew that copper was close to five. I didn't know it hit at five. I just looked. It's at 511.
Well,
That's
that's because I think the Trump policies with the tariffs, and then also, so I think there's going to be a 25% tariff on imported
yes,
copper, and I
yes,
think
yes.
he also just announced, and the news probably leaked ahead of time, that the U.S. is going to be developing some type of copper was just added, I think, to the strategic metal stockpile for the Pentagon because of
Yes,
the data centers.
yes, this is Trump related. This copper price is Trump related, absolutely.
And they said they're going to fast track, I think, more copper deposits in Arizona and Idaho and Montana and Alaska, so and Nevada. So there's going to be more copper and gold mines, especially copper, though, because they view it as strategic. Those permits are going to get approved faster for copper mines.
Wow, that's good for Arizona Metals. It's a gold copper project in Arizona. It's good for them.
So for our listeners out there, since you wrote a textbook on how to invest in gold and silver, where do you think listeners? Because some of my listeners here, they're just getting started in gold and silver. How do you think they should start investing in gold and silver?
Yeah, they should start by reading my book. Absolutely. My book is the only one that really explains how to understand, how to analyze an exploration developer, producer from just about every angle. How to understand the risk, how to understand all the data points. I explain all the data points in detail, and then how to value them. So yeah, my book is a really good resource for anybody who wants to get into gold and silver mining stocks investing. So I definitely recommend it. It's on Amazon, either paperback or digital, your choice.
Oh,
Thanks.
rather than the book necessarily, I was talking about like buying actual metal first, looking at royalty and streaming
Oh,
companies for the majority capital, and then maybe speculating on some of these juniors that you were talking about with
yeah.
gold.
Well, okay, so everybody's different. It depends on your risk appetite. So and it goes to extremes. So I always say that if you're rich, let's say you have $10 million in liquid assets, you're basically a rich person, but you don't have any gold and silver exposure. Um, I really think that you should buy the really high quality producers, like 100,000 each, and just to collect the dividends and the alpha, and get yourself exposure to the golds. So basically do Agnico Eagle, Newmont, Barrick, Goldfields, uh, Northern Star. So the very high quality, and then Franco Nevada, and then Wheaton Precious Metals, those two royalty stocks. You just buy the cream of the crop, 100 grand each, and just collect the dividends and the alpha, and then just ride this thing up. And then of course, you also want to have physical gold, physical silver on top of it. So that's for the super wealthy. Then the other extreme is the people that want to chase alpha, which is really high, is basically high risk. So on the chasing the alpha, I don't recommend exploration, because the risk reward on exploration is just terrible. You're just going to have bad luck. It's really hard. The only way to really do exploration is to chase early discoveries, and then see if if that early discovery turns into a big discovery. Um, or on exploration, you can go for optionality for a company that has a whole bunch of gold in the ground, but they're value cheap, like Free Gold Ventures or Banyan, Getchell, Lahontan. These companies that have gold in the ground, they're valued at $10 an ounce or less. You can do that for exploration, but for me, for alpha, the real strong area is development plays that check all the boxes. So I have a video on my YouTube channel that explains. I actually did a presentation at VRIC in January, and I have these check boxes for developers. and you want to make sure they check all the boxes. So learn, that's why you have to read my book. You have to learn which developers where your risk reward works. And there are certain developers that check all the boxes, and those are the ones you can really get good alpha. But developers is never a near-term bet. It's always going to be 2 to 3 year bet. And then the other place where I think you can get really good alpha is buying undervalued producers. Like right now, Newmont's like a three bagger. So you can find 10 bagger producers like Avino. When Avino was at 40 cents, I said it's not getting any cheaper than that. Now it's at $1.85 and it's still a 20 bagger. So if you would have bought a producer, Avino at 40 cents, I think it has potential to be 30, 40, 50 bagger at 40 cents if they don't get taken out. So you can find, I think, producers. Um,
Do you
you
target
want
the Lassonde curve? Because I've interviewed a lot of other people, whether it's Lobo Tigre or others, and they tend to look for that Lassonde curve there where the junior
to,
has drilled out a lot of the property. It's clear they have a deposit. Maybe they raised the fund, started construction. The mine's almost done. The shares crash. And then, like the Lassonde curve says, that's the time to go in there when the mine's almost about to be done with construction and the share prices crash. Do you target anything on the Lassonde curve?
To a certain extent, yes. So for me, I mentioned earlier about on exploration plays, you want to get them when the discovery hole is found, and that's the beginning of the Lassonde turf. So and then it goes up the discovery. You have that discovery, it gets drilled out, and then they go in development, and then it crashes down, and then you buy it again. So yeah, so I like both of those entry points. So you wait until it gets really close to production. So you let them spend all that money on development. You just sit, you watch it. You don't, and then as they get closer and closer to development, you jump in. Like Next Gold is a good example. They were treasury metals, and for years and years, if you would have bought that years and years ago, you just kind of tied your money up. But now it's getting close, so you wait until it gets close, and then you jump in. So I think Next Gold actually makes a lot of sense here. West Red Lake Gold is another one. So when a development play is close to production, and they have insiders. It's important that they have insiders. They're not just going to give this thing away. Then that part of the Lassonde curve, I like those two. Close to production, early discoveries. I think both of those. I think the Lassonde curve works well on those two. Back to producers. I think that you can, for me, the key thing for producer is you want to find it undervalued. Now, what is undervalued? For me, it's like the free cash flow is like under a five. And here's the key here, and it has additional production coming down the pike, which isn't part of their current free cash flow. So they're currently at a five, but yet they're going to add production. So you're always looking for producers that are going to add production. A good example is like Aris Mining. Aris Mining is producing like 250,000 ounces today, and they're valued at like a three multiple, and they're going to expand production this year and next year to 450,000 ounces, which isn't built into their current free cash flow. So their current free cash flow is actually under a one right now if you include that 450,000. And they shouldn't have to dilute because I think they're pretty much financed. One mine is going to be done in Q4, which is Segovia expansion, maybe Q2 this year. And then this year and next year, they're building Marmato underground. And so, yeah, so if you can find a producer that has a low multiple, like around a five or less, and they're going to add production, those are the sweet spot for me where you can find some big alpha.
And you have to do that with the management team can't do share dilution or the reverse stock split. So you've been in the space now for over a decade. You've seen it with a lot of
Yeah.
these juniors where the mine does not come in on time and on budget, or the miner does a bad acquisition, and
Yeah.
then the mine doesn't. There's delays building the mine. They didn't. They have to do it at a higher interest rate. I mean, look at what happened with Equinox Gold. I mean, if you bought Equinox Gold recently, I think you got a bargain on some of the shares because Greenstone is not really priced in yet over the last like 12 months or something like that. However, if you've owned shares of Equinox Gold for the last 3 to 5 years, you've been a bag holder. I think the shares are down over 80% if you bought and hold the shares 3 to 5 years over the last 3 to 5 years.
Oh, and it's over and over again. Companies, development stories, they're going to break your heart over and over, and they're going to break your heart because you mentioned a lot of the things that can go wrong. They can dilute you. They can have overrun cost overruns, and then when they finally do the ramp up, it could totally fail, like Arcana went bankrupt. Alexco, they couldn't get their mine to work. And then Ascot, they're having all kinds of trouble getting their mine to work. Then you had Pure Gold, they couldn't get their mine to work. So you invest in these companies and they can't get the mine to work. So yeah,
It's about finding the sweet spot, like Don said. So the risk reward, that like all the bad, the question I ask myself looking for red flags is all the bad news priced in? Can the company survive? So like with Equinox Gold a couple years ago, they had just bought White the mine to start construction on Greenstone, right? And then they had to do it at a higher interest rate environment during the pandemic. So that meant higher costs and there were some delays. But now here we are, what, a couple years later. If you haven't bought shares of Equinox Gold, now risk reward, it's looking a lot cheaper from a valuation perspective. And Greenstone is done with construction, and what the mine is ramping up, it's at commercial production and it's almost to nameplate capacity. So it's a different picture than a couple years ago.
yeah. The other thing is you can get a good feel if a company's if the mine is if it's a tough mine to build or if it's an easy mine to build. Like a lot of times, like these open pit projects, they're they're not going to run into most of the time. The costs are going to be it's a fairly known, unless we have inflation, of course. But we know what the engineering is required to build an open pit. Most of the time you just don't digging the ore out of the ground and sending it through the mill. And so it's kind of a known quantity, is my point. And so the risk goes down. Like all the mines that I mentioned that had trouble, they were all underground mines. It's pretty rare for an open pit to fail unless the price of gold goes way, way down. Um, and so
Well, or
some
you have a heap leach pad, like an accident. So
so
that's
an
like for the
accident,
open pit.
yes,
The ones that we've seen the last couple years are a heap leach pad accident. So it's not the
yes,
problems that Don said. It's like an accident with the heap leach pad, and then all of a sudden, here's the mine has stopped. The mine has to shut down. Workers have died. There's no cash flow from the mine, and then the government is going to be suing the mining company and or like with the victims if anyone died in the mine, and then there's also what hundreds of millions of dollars to fix the mine, remediation fees and cleanup and stuff like that too.
right. Yeah, that's one of the reasons I like to keep my allocations low because you cannot anticipate a problem. You don't know which company is going to have a problem. Any company can have a problem for a variety of reasons. And so I always wince when I do some coaching for people and they'll send me their portfolio and they'll have these really high allocations for these companies and they're just gambling that these companies don't have a problem. So I like to keep my allocations low enough so that they don't bite you. You don't want a single stock to bite you, if you will. I remember when I first started doing this, and people used to say, these very low allocations. I'm going, what? It's like 0.5% allocation. And I'm like, 0.5%. And now I'm like, 0.5% is a lot. I've changed my tune on that because when you first start doing it, you don't,
Well, Franco Nevada was considered bulletproof for many, many years, and they had what the Cobre Panama. I think what 25% of their
yeah,
cash flow
yeah,
was to Cobre Panama, and it wasn't structured properly with a lot of protections for a normal gold stream. So the shares dropped what 40%. I mean, if you didn't own
yeah,
Franco Nevada, it was a bargain at
yeah,
$110, 120 a share. You're up.
yeah.
You're doing very, very well over the last year or two. But if you rode that down from 150, 160, 170 share down to 110, I mean, you're sending me nasty messages
Yeah.
on social media.
Yeah, and Hecla, the Lucky Friday mine, that was a labor strike. They had a strike in the Lucky Friday mine in Idaho a couple of years ago. Their share price went down 30%. It's like just on a labor strike. So you never know. It was like a buying opportunity. I'm like, you got to be kidding me. You really think it's going to stay down 30%? And sure enough, it went down, then turned around, went right back up once they reopened the mine. But it was down.
But Don, they're going to start replacing those humans that are going on strike. They're going to start replacing them with robots soon, so there won't be any strikes.
It's not a long shot. That could happen, especially with some of the trucks, the automated trucks like the open pits. because of those trucks and
Well,
some driving trucks.
have you seen any of the videos recently from Boston Dynamics with the Atlas robot or from China with the Unitree robot? I
Oh
mean, the
yeah,
robot's doing martial arts, like expert level martial arts and backflips and stuff without any cords.
yeah, it's possible. We could see some of that, but you know, one thing I want to add about all this talk, about these miners and everything is, I think this is a once in a lifetime trade. I don't think this is a long. These things go in cycles, and these cycles are way spread out. We had 1980, and then we have 2011. Now we have 2024. So these long gaps between when you make money in these things. So I think this is a kind of a once in a lifetime kind of trade here over the next 2 to 4 years. And so that's it. And we're just trying to make some money. I think the HUI is going to go from, it's at 350 today. I think it's going to go all the way to 1200 to 1500.
So
So I
that's
don't,
over 4x move, you see?
yeah, I really do. And I don't think we need to really get out before 1,000. So we ride this thing to 1,000, and then we start taking our profits at about 1,000. So from 1,000 to 1,500, we're getting out. But I really do think this is, we're in an upcycle here, and the next upcycle is not going to come for a long time. It's like, so yeah, that's how I think of it. I think of this as a kind of a once in a lifetime. Like a trade. I equate it to Michael Burry when he put all of his fund, put all of his fund into market-backed securities.
And he was a
All,
value investor, so he actually went against the bylaws of the fund. So he had people pulling their capital out. So even though he was right, he still had his investors saying, "You are not doing. We gave you these assets under management, wrote you millions of dollars in checks to buy Warren Buffett value stocks, and now you're buying shorting mortgage-backed
Yeah,
securities instead."
shorting. Yeah, he went completely against what he was doing. But my point was, it was a trade for him. He put all of his money into it, 100%, which is kind of what I'm doing, like 90% gold and silver. And then once it was over, he sold it. He was done. I'm okay, I'm done with that. I moved on. And now look what he's back. He's back to value investing. And that's exactly how I look at this. I'm 90% in gold and silver. As soon as it's done, I'm going to sell all my stocks, all of them. I'll be completely out of mining stocks, and I probably will never go back into them. So I look at it as a trade, just like Burry did in '04 to '07. It's just a trade. It's just like we're going to take advantage of this craziness in the market. I mean, that's what Burry saw craziness. He saw it. I mean, I love that movie where he says it's a certainty. It's a certainty. That's how I feel about the gold and silver miners. It's a certainty.
Well,
It's
his
just a matter
investors
of
didn't
when.
because he had tons of his investors
Oh
pulling
yeah.
funds out and trying to sue him, but he had a lockup period, if I remember correctly, on a lot of the funds. So that actually allowed him to profit from the trade. Otherwise, they would have pulled all the funds out and his investors wouldn't have made any money on
Oh
the
yeah.
trade.
Yeah. I think he made 100 million, and if they would have stayed in, he would have made like 5x that, maybe more. Yeah, a lot of people pulled out, but he still made 100 million in profit, net profit, um, which
That's
was a
just the nature of the money management game, man. I mean, a lot of people, a lot of those institutional investors, they give the wrong money to the wrong hedge fund
let's
manager, and the hedge fund
I
manager kills them on fees. I want to ask you though, so I do see good risk reward for a lot of these gold stocks with their free cash flow, the profit margins. What risk do you see? Do you see risks in specific countries, like the country bans mining or raises the royalty
oh
tax
God,
on mining? What risk do you see blocking things playing out the
yeah,
way you expect?
yeah, tons of risk, absolutely. So you don't make this kind of returns. We talked about 4x, right? 4x return here coming up, I believe. You don't get that kind of return without risk. So yeah, we're taking tons of risk. I think, the biggest risk I think is going to be location risk, country risk. So some of these countries are going to increase their taxes. Some of them are going to require national country ownership, like, give us 10% of of it. That's kind of what Mali's doing, right? Like, you give us a higher percentage ownership, plus they're going to increase the royalties. So I think that is by far the highest risk. They're not going to nationalize the mines because they just don't have the manpower to do it. And if they do that, then no one's going to invest any money in their country.
Well, look
So
at Chile. I mean, Chile has threatened the last couple of years when the copper price spiked a couple of years ago, right? They started increasing the royalty taxes on copper, and the investment from the mining companies into the country collapsed. I think
yeah.
their copper production was trending downwards over the last 3 years. So, yeah, we have a spike in the copper price recently,
Perfect.
but there's a lack of investment into the country of Chile now for a lot of copper mines.
Yeah, a perfect example is Venezuela, right? Venezuela has a lot of gold. And there's still legal cases going on in Venezuela, and that country it's been persona non grata for investors, for miners for a long time. So they basically nationalized the mines in Venezuela, and there's no investment money at all in Venezuela.
Well, they don't protect private property for foreigners unless you're connected to the Chinese government or Putin or Iran. So, like a lot of those foreign governments, they protect private property rights there through military stuff. But for Americans there, yeah, there's no private property protection for indirect investment. I mean, it's just not a safe country right now.
Yeah, the second example is Bolivia, who back in the Morales days was doing nationalization and no money was going into Bolivia. And now they've turned that around because they recognize that mining is a big part of their economy. And so, I don't expect nationalization, but I do expect higher taxes, and I do expect where they require equity ownership by the government. And a lot of time it's free carry, so they basically just give me 10%. Um, the
Yep,
country
that's how
does that.
government that's how royalty tax works. Yep, the government does nothing and just wants to collect a check. Yeah.
Yeah. So yeah, so when that happens, we're going to get rug pulled, and then no investment, and your stock's going to go down 25% overnight. So I know, like West Africa, I'm going to get nailed in West Africa because I'm too overweight there. Another country I'm going to get nailed in is Mexico. I'm overweight in Mexico because they have so many silver miners. And so I think Mexico is going to raise their taxes on once silver gets to 40, 45, 50, Mexico is going to come in and increase their taxes. It's inevitable. And so we're going to get rug pulled there. And so we might not get the free cash flow margins that I'm hoping for. Like I'm hoping a lot of these companies get at 20. And if they have operations in Mexico, they probably won't get a 20. They'll only get like you watch Hecla will get a 30 multiple because all of their mines are in North America. Um, I think they're at 18 right now, and it's all about location risk. And then Australia, I think a lot of these Australian companies are going to be high teens, maybe 20s, because of location risk. So you want to get in better locations to lower your risk. I think by far the biggest risk is taxation and royalties and government ownership, equity ownership.
Yeah,
One, one,
I think people have to be careful about overly concentrating their investment portfolio for either speculation for their juniors or small producers with one mine into specific countries. Now there are some countries, I think Argentina is one of the few ones where things are actually headed in the right direction. So I would argue that Argentina with Malay and some of his new tax policies for 500 million or more of investment over the next couple
that's
of years, that
that's
Argentina at least for a couple of years now will be pro
awesome.
mining.
Yeah, I'm very bullish about Argentina. They're gonna lower or remove currency controls this year in Argentina, and that's gonna have a huge impact. Yeah, what's happening in Argentina is very, very positive. It's the most pro mining country right now in, I think, South America. I like Guyana and Brazil, but I think it's gonna be number one. I wanted to go back to the Burry. Burry, he basically saw an investment and he jumped into it. I think what's going to happen right now is we're going to start to see investors, big investors, go into gold and silver mining who don't do gold and silver mining. Like Burry, he doesn't own a gold miner. Buffett doesn't own a gold miner. I think what's going to happen here is we are going to see some big money go into the gold and silver mining space soon.
I think
And
you're right.
I think
I
it's gonna
think we're
turn
seeing
heads.
a I 100% agree. I think we're seeing a 1 to 2% increase in allocation. And so if you're 50 billion assets under management or 100 billion assets under management, that 1 or 2% allocation to
Huge,
physical metal, so
huge,
it's like some Sprott physical gold or silver trust or gold stocks, that is significant.
huge, absolutely huge. I mean, if you look at the market cap of all the silver miners, like a billion, well, maybe not. I mean, it's less than $1 trillion. It's not that much. 10 billion, 100 billion. The biggest one, no, that was gold and silver combined is a trillion. Forget what it's like $100 billion, I think, for all the silver miners.
Well, a lot of the stuff in the silver markets is paper stuff, so paper derivatives, and that's why you're seeing issues right now with the LBMA and the COMEX. Is that there's actual entities out there? I think institutional investors, not just central banks. The institutional investors are wanting actual allocation to the metal. So I think you're seeing more demand for the actual metal than there's been. And I think there's a phase shift over the last 3 years with a combination of central bank demand for gold, retail demand for gold and silver, and now institutional demand. And I think like the analogy I was using, Don, before we start recording as we wrap up here, because my dogs are barking really loud in the background. The analogy I'm using is like it's a boxing match. So all the gold and silver experts have been predicting this for many, many years, every single year, that eventually we'd get to this point with higher metals prices, a higher price floor like this, and problems at the exchanges where entities would want the actual metal over what gold and silver futures contracts or GLD or the other derivatives. And so basically it's like finally later in the boxing match here, the analogy, all these jabs, all these body blows is accumulated damage. And that's why there's not as much metal in the vaults at these exchanges and why the prices are relatively higher.
Yeah, we can end it here. This is where we started, and we brought it all the way back around. Is basically all of these factors that are pushing gold higher are all coming to a head. I actually think that we're going to see some shortages in both gold and silver. And people say, well, you can't have a shortage because price will make the difference. Well, you can't have a shortage where you can't obtain it. It's called unobtainium, right? You
Well,
can
you can have a
wait
shortage for
for it.
6 months. So, where a COMEX
Yeah.
contract, they might get you to make you wait 6 months or a year. Or,
Yes.
I mean, I agree with you. You say it's a function of price. So, if the gold price stays at 3,000 for the next couple of years, there will be more mine supply. I mean, if the copper price is at 5, there'll be more mine supply. Silver price goes to stays at 35, $40 for a couple of years. There will be more mines that get funded. It's just not going to come right away. So, it's going to take years to bring that new supply online.
Yeah. Like, you want your hands on, let's say a 5 or 10 ounce bar of silver. We're gonna come to a point where you're not going to be able to get your hands on it for several months. That's what I mean by shortage. It's like you go online and you go, okay, I go to AppMex and say, okay, I want, you know, some 10 ounce bars. They're going to say, okay, here's the price. We'll sell it to you, but the shipment will be delayed. Right, that's what it'll say. In other words, they don't have any inventory. That's kind of what I mean by shortage, is that there just won't be any inventory. And then once there's no inventory, I think prices will trend higher. And that's the key. Prices will trend higher because there's no inventory. And I think that's going to happen for both gold and silver, both, but especially for silver. But yeah, so
And it looks like on the LBMA at least that a lot of the entities that normally would have been happier with these paper derivatives, right? They don't want the derivatives, they want delivery of the metal. So whether that's a hedge fund or institutional investors, the non-G7 central banks, what the Germany and Poland and India, they've been demanding physical gold delivery for years now. But a lot of other entities are actually asking for metal. They're not happy with the derivatives anymore.
right. Last I heard, LBMA is having delays on deliveries for gold. So that already sounds like a shortage.
Yeah, I mean it's the difference that so I think like the YouTube title say like shortage immediately, you're not going to get any metal. I mean you will get the metal eventually. You're just normally
Yeah.
not gonna you're gonna have to wait though. But I
Yes.
mean if the gold price stays at 3,000 Don or it goes to 3,500 in 18 months, I could see 3,500 in 18 months or less. Goes to
Yeah.
3,500 and it stays there. There will be more mines that get funding.
Absolutely. Absolutely. Yeah. All right, Jason. I appreciated the talk.